Hello, everybody. I'm John Bainham, President of Retirement Income Group, and today I have a special guest that we're going to be talking to you about something called the Personal Pension Plan, or the PPP, and his name is Jean-Pierre Laporte. And he is are you President and CEO of Integris?
Just CEO.
CEO of Integris Pension Management. And he has created something very unique in the Canadian landscape called the PPP, which I just mentioned. I'm going to start off with asking a simple question: what is a PPP pension plan to begin with?
So yeah, a personal pension plan, or PPP, is a registered pension plan. So when you think of registered pension plans, you might be thinking of teachers, civil servants, people like that have had these gold-plated pension plans for many years. So that's what a PPP is. It's a registered pension plan, but it is different than what has been around for a long time, in that it combines two types of ways of saving for retirement. It combines the traditional defined benefit pension, like the Teachers Pension Plan of Ontario, with another more simple way of saving for money, which is a defined contribution type of arrangement. So it's a combination registered pension plan. That's what it is. And we'll see in the slides later on that we have a little graphic that explains that a little bit better.
Yeah, that's great. And this is a question that I get all the time as a financial advisor, is why, and usually for this defined benefit pension plan, we refer to it as an IPP. When you're talking about small business owners, privately incorporated individuals, why create the PPP pension? Why create PPP when you could have just sold IPPs this whole time?
Yeah, sure. I mean, no one forced me to sell PPPs. I could have just sold IPPs and saved me a lot of grief trying to educate millions of Canadians about the PPP. But the PPP, and you'll see later on in the presentation, that because of this triple account combination registered pension plan structure, the PPP allows Canadian taxpayers to contribute significantly more money towards their retirement than an IPP, and a lot more than an RRSP, which is why people upgrade from RSP savings to pension savings in the first place. So we'll talk about some of the differences, but the bottom line is that over a lifetime, it is easy for a customer that uses a PPP to end up with over $800,000 more in retirement than someone in an IPP, all else being equal. So everything else held constant, because of this triple account structure, a PPP customer has a nice $800,000 advantage over the same person with an IPP. And that's why we're offering PPPs and not IPPs. If I wanted to, it would be a lot simpler to offer IPPs, because most people know what that is, and it would just be a straight sale. But here we're trying to give you the better model.
So what is PPP? So you mentioned the 3-account structure, the defined benefit component, defined contribution component, and the additional voluntary contributions. The three prongs. So do you want to kind of give a quick summary of this?
Sure. Yeah. So when you're talking about an IPP, we're talking about the gray defined benefit segment. So everything an IPP offers under the roof is here. It's subsumed. It forms part of this component of the PPP. So there is nothing an IPP has over us. We have everything it has, plus we have the defined contribution and AVC components bolted on. So under the defined benefit component / IPP, we can do a number of things. One of them is do annual contributions, which we call current service in pension jargon. And we can also do past service buybacks. So business owner has paid him or herself T4 income in the past in the form of salaries or bonuses. We can recognize all those prior years under the formula and enhance the size of the pension payable. And part of the cost of buying back this past service comes from the corporation, so it creates a corporate tax deduction. The other piece typically comes from the member's own RRSPs, So those get transferred into this account, and we call that a qualifying transfer. So that's the basic model. And then we've got the defined contribution account, of course, which allows you to contribute 1% of salary. And its companion account is the additional voluntary contribution, the yellow account. Mm-hmm. When we are in DC mode, if the corporation is putting in 1% of salary, or T for income, the individual plan member can contribute from their salary anywhere between 0 and 17% of salary. And that's a voluntary contribution, and that is a personally tax-deductible contribution. So it's kind of like contributing to an RRSP. It has the same effect of reducing your personal taxable income. But the other aspect of the ABC account that's important is that it also allows you to roll in any RRSP assets that you have, or even RIF assets, by the way, into this account. And when you do that, the tax deductions that are attributable to the investment management fees become live. Whereas if you have money in an RRSP or a RIF and you have to pay investment management fees, usually taken off the top, you can't write those off. Those are non-deductible. But by transferring them into the ABC account, those same fees now become additional tax deductions for the business that's sponsoring the PPP. So it's a great way of turning non-deductible expenses into deductible expenses with no tax consequence.
Yeah, that's great. And one other question that I've gotten from an accountant is, what is unique about this structure? Like, what is the added benefit between just having an IPP and an RSP structure?
Okay, well, there are many. I don't know how we may need to do a second recording for this one. But
just to maybe a quick overview.
Why don't you flip to the next slide, and that's part of the answer. So the key advantage is that because we're allowed to contribute more than an IPP over a lifetime, if we assume that you, as the investment advisor, is able to grow the money at that rate of return, let's say 5% or 10% or whatever, over time, our PPP clients will end up with more money than the IPP customer, and definitely more than the RSP customer, and a heck of a lot more than the TFSA customer, because the TFSA, unfortunately, can only contribute $6,000 a year. Mm-hmm. So all else being equal, because all of these are tax deferred plans, mathematically, if I'm allowed to contribute more, I'm going to end up with a lot more money in retirement. That's the key reason why people would want to upgrade from an IPP to a PPP, and definitely from an RSP to a PPP. Mm-hmm. Now, there are a whole bunch of specific tax situations where the PPP trumps the IPP, and we can discuss those as we go through the slides later on.
Okay, perfect. Yeah, so just in short summary, you can contribute a heck of a lot more into a PPP than you can into RSP or even an IPP, and that leads to long-term outperformance. Exactly.
So it's a pure tax play. There's no magic to it. It's just the rules. Now, one thing that we like to remind advisors and accountants is that one of the other side benefits of using a PPP is that move passive assets that are sitting inside of an operating company or a holdco into a PPP. It's no longer on the balance sheet of the company. So all the passive income rules, the new tax on split income, the new tax on passive investments that the federal government introduced back in 2018, those adverse tax consequences no longer apply to that passive income. So it's a way of escaping these punitive taxes by throwing them into the PPP. Okay. So that's an important point, because a lot of accountants have this in the back of their mind, and sometimes they don't realize that when the company contributes to the PPP, it's off the balance sheet, so it's no longer caught by those rules.
Yeah, so the tax on split income, and also you're also referring to the small business clawback of the small business
Yeah,
deduction.
that's right. The tax, the TOPI, the tax on passive investment that applies when you have over $50,000 of safe passive income. Then you get for every one additional dollar of passive investment income, you get a $5 reduction to your small business tax allowance of $500,000. So your tax rate on your active business income jumps up from 12.2% to 26%. So by being able to move money out of holdco into the PPP, indirectly by lending it to OpCo or directly from OpCo into the PPP, we're now having this passive income growing tax sheltered inside of a PPP off the balance sheet. So no longer causing any adverse tax consequences.
Yeah, that's great. You're moving money into a PPP, which protects it from these rules on passive investment income, which is great.
Yep. So that's an important slide to keep in mind.
And I know that's a big worry. I mean, we get questions about that quite frequently. So that's okay. So we've got a case study here as well that we're going to use. I believe it's a doctor that we're going to go through.
Yeah, it's a doctor that's 45. Now he's happy with a 5% rate of return on assets, so he's a very conservative fellow. His medical professional corporation has been paying him T4 income of $150,000 since 2010 when he incorporated. The rest of the money is either retained earnings or dividends if he needs that for lifestyle purposes. And he's been able, ignoring the PPP for a second, on his own, throughout his life, he's been able to put away $450,000 in an RSP, or it's grown to that level. He's 45, but he'd like to retire 20 years from now at 65. And just for round numbers, his corporation on the first $500,000 of income pays tax at 15%. So those are the facts.
Great. And so this is something else I want to point out as well, is because a lot of business owners like to pay themselves with dividends and have different mixes of income. For the PPP, you do need to have T4 salaried income.
Yeah, because it's an employment pension plan, so you need employment income. A dividend is a right of a shareholder, not of an employee. So that's an important legal distinction.
Yeah, perfect. And then one other quick question as well. While we're on the subject of age, he's male, he's 45. This is a frequent thing when advisors are talking about IPPs, is they say you have to be at least 40 in order for this strategy to work. Now PPP is a little unique in that it actually can benefit people who are under that age of 40. I know you want to touch on that real quick as well.
Yeah. So because we have the triple account structure, someone who's under the age of 40, which would be penalized by an IPP setup, doesn't get penalized under a PPP because that pension member can use the defined contribution and AVC side of the plan, and the annual contribution will be significantly higher than what is possible under an IPP. In fact, our youngest Integris PPP client is 16 years of age. And the reason why he's in the plan is because he's with his father and his grandfather. All three are collecting a salary from the same family business. So all three are in the same pension plan, the same PPP. And when the grandfather passes away while collecting his pension, all of his capital, the millions of dollars he's set aside for his pension, instead of being taxed under the deemed disposition rules, which will plague an RRSP, that money will become surplus, which means it's not taxed, and it's available for the father and the grandson. And when the father passes away in retirement, the grandson will not only get the grandfather's money, but the father's money without any tax. So we have what's called an intergenerational wealth transfer. But the grandson could have never benefited from that rule had he been excluded from an IPP because he's too young to make it worthwhile. See, he gets the best of both worlds. He gets to maximize his contributions every year, and he gets to benefit from the surplus left behind by his father and grandfather. So age is no longer an issue with the PPP. It used to be a big problem for an IPP, but we solved that problem.
Yeah, that's phenomenal.
Yeah. Yeah, next slide, I think.
Yep.
So the key question that people ask me all the time is, okay, I know I can max out my RRSP every year. How much more can I put in a PPP above and beyond what's allowed under the RSP rules? Tell me the gravy, tell me the extra, the delta. That's what I'm interested in, because I already know about the RRSP limits. So in the case of this doctor, that's 45 years of age that wants to retire at 65, over the 20-year accumulation period, the pension legislation allows him to contribute and therefore shelter an extra $484,000 above and beyond what he would have been able to do had he maxed out his RSP. So that's the first answer. So almost $500,000 more tax advantage, which I think is pretty significant. But anyway, that's a personal judgment.
Yeah, that's yeah, very significant. Next slide.
Yeah, please. And then the question is, well, okay, so since that extra money is growing at 5% every year, you know, how much more money, how much more gravy money will he have by the time he retires, since he was able to put more in? So if you click again, you'll see the answer. Well, for him, the PPP advantage, meaning the additional registered assets at retirement above and beyond what he could have saved through the RSP system, is over $750,000. So $779,524.
Right. So this is the 484,000 with investment growth.
That's right, at 5% over 20 years. Now, we haven't taken an extra ounce of market risk to put that extra money in our piggy bank. Still 5%.
Yeah, but you have you're creating it with a bigger base, right? Because you have larger additional contributions.
Exactly, and of course, larger tax savings.
Mm-hmm. Yeah, because as you mentioned before, and you know, if people don't remember, you know, your investment management fees are also tax deductible in a PPP, which they are not inside of an RSP.
Exactly, that's another feature. We'll talk about that a little bit later on, but yeah. So let's move on to the next slide. Other direction, I think.
Oh,
so people, yeah, just click about maybe 4 times. People ask me, you know, how come your customer is allowed to tax shelter $484,000 more than mine who's stuck in an RSP? And the answer is very simple. Pension legislation is more generous. It provides for additional contributions that don't exist in the RSP world. And what I've done here is I've set out and I've broken down by category the extra contributions that the PPP client gets to enjoy. The first one being the past service. So here we told you that he incorporated 10 years ago and he's been paying himself $150,000 salary over those 10 years. Well, that allows the company to contribute $52,000 in change, and that's tax deductible to the business. Then every year, because the pension legislation is more generous than the RSP rules, he's allowed to exceed the limit. And when you add up all of these extra bits and pieces of contributions as a total, cumulatively, he's looking at over $315,000 of extra contributions. Remember that yellow ABC account where you're allowed to do personal contributions? Well, over the 20-year period, those rules allow you to almost put $19,000 aside personally. And finally, because we use a 5% rate of return assumption, we are below the target hurdle rate of 7.5%, which is what IPPs and the defined benefit component of the PPP require in order for the plan to be considered fully funded. So given that we're below the target, the company now has a legal right to contribute extra money that we call special payments. Now, in this case, it's almost $100,000 of extra tax deductions through the special payment mechanism. So when you add up all of those amounts, that's how you get to your 484.
Yeah, that's great. Now, I know for some people who talk about you know, the strategy, because you brought up a good point. the pension legislation requiring a 7% rate of return. And I know that one of the strategies is, let's purposely get a very low rate of return inside of our IPP or PPP in order to generate, the maximum amount of special payments.
Yeah.
Is that something that you see frequently, or that you recommend? Or
we recommend it. We don't see it frequently because it's counterintuitive for a lot of people. They say, I want my money to earn a high rate of return. But what they're missing is that, let's say we adopt a GIC only strategy for a PPP. And the most that we're going to get is a 1% rate of return on our GIC. Well, instead of $97,000 in special payment, it could be $300,000 of special payments. Now, if my corporation on $300,000 of active business income is paying tax at 12.2%, and I don't have to pay that tax anymore because I'm directing that money into my pension plan as a special payment, that's akin to having saved at a rate of 12.2%. It is guaranteed. It doesn't depend on me taking market risks. So it's all a matter of perspective. For some people, they would rather put the money in their own pocket through the pension plan than to give it away as corporate taxes to the government, right? Because it's a deferral of that tax. So it's really, and what's really nice about the GIC strategy is that, let's say you buy 1 year or cashable GICs that are earning less than 1%. And March 23rd, 2020 happens again. And the market in 1 day loses 36%. Everybody has lost their shirt. Well, has lost 36% if they're fully invested in the stock market, except you, because you're in a GIC.
Yep. You
can cash those GICs and the next day go on a buying spree, pick up all those stocks that are worth 36% cheaper and hang on to them throughout the recovery. When you sell them, so this is the classic buy low, sell high. When you sell them, the capital gain is not a problem because this is a pension plan. So none of the gain gets taxed anyway. Like, think of how incredible.
Because everything is sheltered. Yeah, for sure.
Anyway, so that's my pitch for that, but we don't force people to do that. That's just one of many special strategies that become live and possible with a PPP. So let's move on to the next slide. If you have any more questions on this one, John.
I don't know if you're going to touch on it a little later, but what happens if you're in a surplus? Because I know that's part of the PPP as well.
Yeah.
The differentiators.
We'll talk about it later on. Yeah.
Okay, perfect.
So there are other tax advantages that are not well known with PPPs. One of them is the fact that all the investment management fees are tax deductible. So here, what we did is we looked at this 45-year-old doctor. We looked at his PPP account balance at the beginning of the projection, and in 2020, we projected it all the way to 2040, and then we assessed a arbitrary 1% of assets investment management fee that's levied by the financial advisor or the firm that he's using. Could be higher, could be lower, depends on a number of factors. But anyway, just for ease of calculation, we use the 1% IMF. So we calculate what the fees are. And then because these are tax deductible to the business, and because I've told you that the business is taxed at 15%, we've assessed a value to the taxes saved thanks to the deductibility of the investment management fees. So you can see all those all the way to age 40. Sorry, not age 40, year 2040. So really, in effect, we've created a credit of, in this case, $47,882. This is something that you cannot do with an RRSP because it's not allowed. So let's move to the next slide because that number will come up again.
Okay.
Remember 47,882 comes up here in the middle. So there are fees in order to have a PPP. I mean, Integris doesn't work for free. So what are the fees? Well, over the 20-year period, the fees would be $48,600. But remember, we've just created a credit of $47,882, thanks to the tax deductibility of the investment management fees. So really, the true economic cost of running this program over the 20 years is a mere $718, which if you divide by 20 is just below 45 bucks a year. So my question is, for 45 bucks a year, what do you get? Well, remember this PPP advantage column in the table above? You will end up with $779,000 more than had you stayed in your RRSP and maxed out your RRSP. So for 445 bucks a year, I'm giving you $779,000 extra.
Doesn't sound like a bad deal.
Well, if that's a raw deal, I don't know what else to do for you.
Yeah. And one other thing too, so the PPP fees, they're not tax deductible, but the investment management fees are. Is that correct?
No. The 48,600 is also tax deductible, but I don't even factor that in. That's that's extra gravy. So it's not really 45 bucks a year. It's probably more like $39 a year. But that's
that 48,000 is also a tax deduction.
Of course. Yep. So let's move on to the next advantage. So the next thing I want to talk about is the concept of terminal funding. So let's imagine that this doctor, instead of retiring at age 65, came to you, John, and said, you know what, I want to retire at 62. I'm still going to work. I'm still going to collect dividends because I'm a shareholder of my own professional corporation. I'm still going to see patients, but I just don't want to get a salary anymore. I'd rather for the pension plan to start paying me a pension. So you can do that. So let's say he says, I want to retire at 62. Let's click a few times. At 62, your pension gets reduced from $175,540, which is the pension in the year 2040 at age 65. It gets reduced to $123,601. If you just click again, you'll see it should highlight.
Oh, perfect.
Yeah. So there's a penalty for retiring sooner than expected. And that makes sense because you haven't contributed for a few years. That money hasn't had time to grow. And you're also depleting the assets of the pension plan sooner than expected. So something's got to give. And the way that the actuaries deal with that is they reduce your annual pension. That's the penalty. But, and if you click again, you'll see that if the doctor decides to, click again, if the doctor decides to contribute an amount of $575,000, this is called the terminal funding amount. This is a contribution made by the corporation with pre-tax dollars. So that money hasn't been taxed yet. And it goes into the pension plan and it creates an offsetting tax deduction for the business, which of course save the business a lot of taxes corporately, right? It also helps you purify your business for the lifetime capital gains exemption, or it might help you create offsetting tax credits if you are selling assets of the corporation and you're stuck with recapture depreciation or capital gains, whatever. All of those things are all tied into this deduction. But what happens by injecting this $575,000 into the pension plan? Now, if you click again, you'll see that the doctor, instead of collecting $123,000 basic pension, he jumps to $169,476.
So higher than what he would have gotten initially.
Well, almost. At 65, he would have had 175,000. Here he's at 169,000. But he's collecting that 4 years sooner. So more money sooner, funded by the terminal funding payment, which itself creates a tax deduction for the business. So not too bad.
No, that's great. And one other quick question. So one of the things that a lot of people are aware of is pension income splitting. what a lot of people, don't necessarily know about is that if you are part of an RPP, you can actually income split a little earlier. So does a PPP also have that advantage as well?
Yes, of course. And actually, if you click again, we'll talk about it.
Oh, perfect.
Yeah, click again. There we go. So this doctor, we told you in the case study, is now collecting $169,000 from the pension plan at age 62, and he has a spouse. Now, if he didn't income split, if you click again, in Ontario right now, he'd have to pay almost $55,000 in personal income tax on that pension. But because he has a spouse, if we click again, he can split that 50-50 with a tax return of his spouse. So by doing that, each person in the couple is now paying tax on half of the money, and cumulatively as a couple, they're paying $36,400 in taxes. So if you click again, you'll see that what we've done is we've saved this doctor and his spouse $18,000 annually in taxes every single year. And now this guy retired at age 62, but we could have had him retire at age 50. So imagine that, being able to save 18 grand a year over a 15-year period sooner than what you can do with your RIF. Now, yeah. What I say, sure. I got the little banner at the bottom that says that's not bad given that the annual cost of the PPP is $2,800. But that's not true. It's not $2,800. It's $45 a year. It's actually $39 if you deduct the Integris fees. So here's the deal. You pay me $39 a year, and I give you $18,000 a year. Again, is this an expensive proposition, John?
No, not at all.
I think it's a pretty good deal.
It's cheaper than my coffee every month. So.
Yeah. All right. Well, 18 grand a year will get you a nice vacation down south every year. So you can think of me when you're roasting on the beach. Okay. Next slide. So really, what have we done? This client is substantially wealthier in retirement than had he relied on the RSP. Why? Because he's got $750,000 more to retire on with no extra market risk taken. The company that he owns and that's an asset of his family has also saved substantially more tax than had he stayed in the RSP. We know that because he was able to increase his tax deductions by over $484,000. And that ignores the terminal funding, by the way, which would be another $200,000. So it's more like $700,000 of tax deduction for the company. And the couple, because really we're doing this for human beings, the couple that's collecting this pension income is saving tons of personal tax each year thanks to the pension income splitting rules. And in this case, it was 18 grand a year. It could be higher, it could be lower, but the bottom line is that the savings cover the costs, which are already covered by other deductions anyway.
And you can income split earlier.
Of course, as early as age 50.
Yeah.
Yeah. And the cost of the program is borne by the tax savings and tax refunds that are inherent to the system, not coming out of the client's pocket. So this is self-financing. You don't have to pay anything to be in this, and you're going to get all these advantages. But if that wasn't enough, we also happen to have the highest level of creditor protection in Canada, because these accounts are protected by the Pension Benefits Act. We also have superior investment options because unlike an RSP where you have to invest in eligible asset classes, we are not restricted by that. So our clients are able to invest in the same things that the teacher's pension plan or the OMERS pension plan, the big institutional class pension funds and foundations. They are investing in stuff that folks like us with RSP cannot have access to. Well, we have access to because we're also a pension plan. And finally, Integris, through its team of pension lawyers, provides fiduciary oversight to make sure that the plan is compliant with all applicable legislation, which you don't get with an IPP that's offered by an actuarial firm because they're not pension lawyers. So you have the most protected, safest, most tax efficient product in Canada, all wrapped into one.
Yeah, perfect. And there's actually, you know, on that point there as well, there was recently some changes to pension legislation as well that could benefit IPPs and PPPs, frankly.
That's right. That's right. Because yesterday, Bill 213, Chapter 19, passed third reading and is going for royal assent. And this bill would allow these plans to be exempted from the strictures of the Pension Benefits Act. So all of the funding requirements, all the filing requirements, the annual fees that the government levies on these plans, all of that will go the way of the dodo bird as soon as the Lieutenant Governor provides royal assent to this bill. So really great news for business owners in Ontario.
Yeah, phenomenal. We're very excited about it as well. So.
Yeah. So before we wrap up, I want to deal with your question about surplus.
Yes.
We talked about deficits and how you can make a strategy out of that.
Do you have any other slides you want to use, actually?
There's one last slide after this, I think.
This one here?
The next.
Okay.
Yeah, this one, yeah. So this slide is important because a lot of what we discussed today, John, is only a fraction of the other tax advantages that the PPP can bring to your clients that they don't even know about. For example, let me just pick one at random. Number 20, cross-border advantage. So if your client is a US person and has to file under the IRS and the CRA, when you set up a PPP, because it's a superannuation plan, and superannuation plans are covered by the US-Canada Tax Convention, any monies that are accruing inside the PPP in Canada don't have to be taxed in the US. So, wow. So that's a nice thing. Now, the other thing is if your client, whether he's US person or not, even just a Canadian resident or Canadian citizen, decides to retire and move to sunnier climes for whatever lifestyle reasons and becomes a non-resident of Canada, as you know, there is a tax called a departure tax. It's a deemed disposition on becoming non-resident of Canada that attaches to all of your assets in Canada. You have to pay tax. You're deemed to have disposed of all your wealth in Canada at fair market value, and you have to pay tax on it. The last tax, it's the last kick at the tax can that the government has on you.
Yeah.
However, that deemed disposition does not apply to what are called exempt assets. And lo and behold, anything you were able to put in your PPP is considered an exempt asset. So no tax on your PPP wealth when you become a non-resident. And the last cross-border advantage is that when the PPP starts paying you a pension in Canada, but you're in the US, let's say you're in Florida, in St. Petersburg or Miami, wherever, it doesn't matter. And the Cart Wealth is sending a check, wiring money to your bank account. The Income Tax Act says that for non-residents, there's a withholding tax of 25%. But that 25% gets reduced thanks to the Canada-US tax treaty down to 15%. So you're only lightly taxed on your pension when you become a non-resident. So there you go. So that's just 1 point out of 20. And that's why the viewers should really call you and call us if they want to learn more about the PPP, because there's so much value packed into this product that most people don't even know about. They have no clue that this is available for themselves or for their clients.
Yeah, and I get the your point earlier how we could probably shoot several more videos that are just as long.
Yeah.
So what about our question about surplus? You mentioned you'd answer that for us near the end.
Yes. So I'm going to use my last couple of minutes just to answer that one. So if an IPP is in surplus or excess surplus is when the assets exceed the liabilities by 25%. Or in other words, when the internal rate of the IPP exceeds 9.375%, then there's too much money in the IPP and the government forces the company to take a contribution holiday. You're no longer allowed to contribute and therefore to tax deduct for contributions, which is not that great, because if you like the tax deductions, now they dry up because you've done too well with the IPP. But in a PPP, remember, we're a triple account combination registered pension plan. So if we face an excess surplus problem inside of the defined benefit account, our members can elect to switch into defined contribution mode. By doing so, they're no longer adding more years of credited service to the defined benefit formula, which means we no longer have to report pension adjustments. And you'll remember that a pension adjustment is a measure of the tax assistance you got through the pension plan. And it's,
and it lowers your RSP contribution room.
Exactly, it eliminates it. But we don't have that problem because we're not using the defined benefit component. We've now decided to accrue under the defined contribution side of the plan, which means that our RSP room is now reestablished and available for contributions. So out of the salary we're collecting from the business, we can turn around and contribute to the RRSP, get a personal tax deduction, which is nice, which the IPP customer cannot do. And then as a bonus, we can always take the RRSP and roll it tax-free using a CRA form T2033 into the yellow AVC account, thereby converting it from RSP assets to PPP assets, which means that now the investment management fees on those monies can also be written off by the corporation. Now you're probably thinking, John, well, how often do you get 9.375%? Is that even like a real thing, right? So I asked myself the same question. And instead of speculating, I went and I looked up the Dow Jones index for the last 40 years. And then I looked at the TSX index for the last 40 years. And every year that the index earned more than 9.375%, I put a little check mark. And then I counted up all the check marks over 40 years. Well, it turns out that it's more than 50% of the time. So,
yeah.
So interestingly enough, this feature is actually very important because with the IPP, you're stuck. You cannot continue to make contributions because of the contribution holiday, and you can't put money in your RSP either.
No, you're stuck either putting it into a TFSA or just leaving it in your retained earnings to invest in your. Exactly. As you know, your passive income tax rates are 50.17% and
exactly
so on and so on, right?
Whereas with us, you get personal tax deductions and deductions for the investment management fees every year that the plan is in excess surplus. So you can imagine the gap that starts to develop between the two solutions over time. Which
it'd be quite large.
Yeah, especially when it happens 50% of the time. So that's why the surplus is not an issue with the PPP. It used to be an issue for the IPP.
We've eliminated that unique structure.
Yeah,
that's great.
Yep, and there are more advantages, but I think we've run out of time. So maybe you'll record another one for your folks, and I'm happy.
Yeah, we'll have to invite you back and do another episode for sure. Well, thank you very much for taking time out of your day to have this conversation with us for our friends, clients, referral partners, and accountants that we work with. I think it'll be very valuable to a whole lot of people. So thank you. No. I appreciate the offer for you to come on here.
Thank you so much, John.